What you are about to learn changes how you see money, markets, and the world around you. It is your purchasing power quietly disappearing. Asset prices are not just going up. They are being artificially inflated by a system designed to reward those who already have wealth. And wealth inequality is not just a political talking point. It is a measurable, accelerating consequence of decisions made at the highest levels of global finance. These are not three separate problems. They are three symptoms of the same broken system. And if you have ever wondered why working harder does not seem to get you further ahead, why owning a home feels increasingly out of reach, they linger, they compound, and they reshape the financial landscape in ways that most policymakers did not fully anticipate. We are not talking about modest adjustments or routine policy tweaks. We are talking about trillions of dollars injected directly into the global financial system. Following the 2008 financial crisis, and again during the pandemic of 2020, central banks deployed emergency measures on a scale never seen before in modern history. The United States Federal Reserve alone expanded its balance sheet to nearly $9 trillion. The European Central Bank, the Bank of Japan, and others followed similar paths. The stated goal was clear: stabilize collapsing markets, prevent economic freefall, and restore confidence. But here is where things get complicated. The consequences of flooding an economy with that much liquidity do not simply disappear once the crisis passes. These quiet distortions accumulate slowly, largely invisible until the pressure becomes impossible to ignore. When central banks decide to stimulate the economy, they have two primary tools at their disposal. First, they lower interest rates, making borrowing cheaper for banks and businesses. Second, they purchase assets, typically government bonds, through a process called quantitative easing, effectively creating new money and pushing it into circulation. The intention sounds straightforward enough. More money flowing through the system should encourage lending, spending, and ultimately growth. But here is where the reality diverges sharply from the theory. This newly created money does not travel in a straight line to ordinary households or small businesses. It enters through the financial system, moving first through large banks and institutional investors, and quite often it simply stays there, circulating within financial markets rather than reaching the broader economy. When excess money floods the financial system, something predictable yet damaging begins to unfold. Rather than flowing into factories, innovation, or job creation, much of that capital searches for the fastest available return. It pours into stocks, real estate, and cryptocurrencies, not because these assets have suddenly become more valuable in any fundamental sense, but because money needs somewhere to go. Investors, both large institutions and everyday individuals, follow the same logic. If holding cash means losing value, put it somewhere that appears to be growing. The result is a surge in asset prices that increasingly disconnects from underlying economic reality. A stock may rise not because the company is performing better, but simply because more money is chasing fewer opportunities. Real estate values climb not because wages have risen proportionally, but because capital is abundant and alternatives are limited. This is how monetary excess quietly reshapes entire markets, recognizable only in hindsight and devastating in the moment. When asset prices rise steadily, it does not feel like a warning sign. It feels like growth. It feels like prosperity. Investors feel wealthier. Headlines celebrate record highs, and confidence builds on itself. But beneath that optimism, something more fragile is taking shape. An asset bubble forms when prices detach from the underlying value of what is being bought. The asset is no longer priced on what it produces or earns, but on what someone else might pay for it tomorrow. That distinction matters enormously. History has shown this pattern repeating across centuries. This is where the consequences become deeply personal. Asset inflation does not affect everyone equally, And that distinction is at the heart of one of the most pressing economic divides of our time. When central banks flood the system with liquidity and asset prices climb, those who already own stocks, real estate, and investment portfolios watch their net worth expand, sometimes dramatically, without doing anything differently. Their wealth grows simply because they were already positioned inside the system. But for those without financial assets, rising markets offer almost nothing. No portfolio appreciating in value, no property gaining equity, no stake in the rally. This is not a matter of individual effort or ambition. It is a structural outcome built into how modern monetary policy operates. Wealth begets wealth when asset prices rise, and those starting without assets are left watching from the outside as the gap quietly, steadily widens. For families without investment portfolios, the consequences of asset inflation are felt in deeply personal ways. As property values climb, renting or buying a home becomes increasingly out of reach. Housing costs consume larger portions of monthly income, leaving less room for savings or emergencies. Education expenses follow a similar trajectory, rising faster than wages year after year, pushing families deeper into debt just to access opportunity. Even everyday essentials, from groceries to healthcare, reflect the broader inflationary pressure rippling through the economy. Meanwhile, wages for working households often crawl forward at a fraction of the pace that asset prices accelerate. The result is a widening divide, not simply between rich and poor in the traditional sense, but between those who own appreciating assets and those who do not. This structural gap compounds quietly over time, making upward mobility increasingly difficult for those starting without inherited wealth or existing investments. It is the predictable outcome of structural conditions that have been building for decades, quietly reshaping who benefits and who falls behind. They are three expressions of the same underlying system operating under the same conditions. Excess liquidity drives asset prices higher. Rising asset prices concentrate wealth among those who already hold investments. That concentrated wealth flows back into financial markets, inflating prices further. Meanwhile, rising costs erode the purchasing power of those without assets, deepening the divide even more. Each force feeds the next. Inflation pressures households. Asset bubbles reward the already wealthy. Wealth inequality limits who can participate in the next cycle of growth. What happens in the world's major financial centers does not stay there. When the United States Federal Reserve adjusts interest rates or the European Central Bank launches a new round of asset purchases, the consequences travel far beyond their borders. Capital is inherently mobile. It moves toward opportunity and away from risk, crossing oceans in milliseconds. Emerging economies often bear the sharpest impact of decisions made thousands of miles away. When wealthy nations flood their systems with liquidity, that capital frequently flows into developing markets, inflating local asset prices and currencies. Then, when policy reverses, that same capital exits just as quickly, leaving economic instability behind. Nations that had no voice in the original policy decisions are left managing the fallout. This global interconnectedness means the financial system operates as a single organism rather than a collection of independent parts, making it simultaneously more efficient and far more fragile than it appears on the surface. That awareness is not optional anymore. For anyone navigating the modern economy, it has become absolutely essential. There is no single moment where inflation, asset bubbles, or wealth inequality announces itself at your door. Instead, the changes arrive slowly, embedded within systems that feel entirely ordinary from the outside. Your rent increases a little each year. Groceries cost slightly more each month. Home ownership drifts further out of reach. None of these shifts feel dramatic in isolation, but together they represent something deeply structural happening beneath the surface of everyday life. This gradual invisibility is precisely what makes these forces so powerful and so dangerous. Systems designed to appear stable can quietly redistribute opportunity and wealth across entire generations without triggering widespread alarm. Financial literacy built on these deeper foundations becomes one of the most valuable tools available to anyone. It is increasingly relevant for anyone making decisions about where to live, how to save, what to invest in, or how to plan for the future. When you understand that inflation can erode purchasing power silently, that asset bubbles can collapse without warning, and that wealth inequality shapes opportunity in ways that are rarely visible, you begin to see the financial landscape more clearly. This awareness changes how you interpret news, evaluate risk, and think about long-term security. It helps you ask better questions rather than simply accepting surface-level explanations. The goal is not to predict the future with certainty, but to navigate it with greater clarity and intention. A disclaimer now appears on screen. This content is for informational and educational purposes only and does not constitute financial or investment advice. Asset prices have been reshaped by trillions in intervention. Wealth has concentrated in ways that compound quietly, year after year, and inflation has redefined what stability even means for ordinary households. These are not temporary disruptions. They are structural realities that will define the financial landscape for years to come. Understanding them is not a luxury reserved for economists or investors. It is a form of literacy that belongs to everyone. The more clearly you can see these forces at work, the better equipped you become to navigate what lies ahead. Knowledge does not guarantee outcomes, but ignorance makes you far more vulnerable to them.